All right, let's get a move on then and put the spotlight on the macros. Much to talk about with respect to the Q2 GDP data, or shocker, should I say, as well as what the outlook is when it comes to the Reserve Bank's future rate action. B. Prasanna is joining in. He's Group Head Global Markets at ICICI Bank. Thank you so much for taking time out. We have seen the slowest GDP growth print in the last 7 quarters. Should one really be reading into this print with a microscope, and should we be worried?
Yeah, so good morning to your viewers. I think you use the right words that it was a shocker of a GDP growth number. To be fair, I think most of us expected a slowdown in the Q2 GDP number based on the high frequency indicators which have been coming in the months of July, August, and September. And we were kind of prepared for a slowdown. But I think 5.4 was something that none of the people in the street kind of expected. It's at least 100, 110 basis points lower than what the consensus estimate were. And if you really look at, what has been the driver of this slowdown, it was actually slower government spending, which we all of us knew was there in the Q1, but Q2 as well, there has been a slower government spending. And actually, the one that had that worried is about the growth that was in manufacturing, especially the mining and the electricity demand, which is, kind of taken a hit. Add to that the consumption slowdown that we were seeing. So it looks like a bit of investment as well as a bit of consumption, both of it actually slowed down, leading to this kind of a number. Now, many reasons can be attributed it. Some of the obvious ones are the fact that rainfall intensity was very high, and government really did not spend as much. But there are also maybe some other subtle reasons like the tightness in liquidity that RBI had been, indirectly gaming for 3-4 months prior to this period, and the credit growth moderation and the macroprudential norms that they have been driving at. And to some extent, maybe a long-term reason is the post-COVID spending splurge also coming down. So net-net, I think the GDP was a shocker, but we think it's kind of bottomed out. It's going to improve in the second half. But even after the improvement, we do pencil in FY25 GDP of around 6.5%, second half GDP of around 6.5%, and FY25 GDP growth of 6.3%. So these are good numbers, but these are much less than what we were, expecting, even about RBI was expecting at the beginning of the year, upwards of 7%. So yes, there is a revision lower to the extent of 50 to 70 basis points for the year.
The general view is that government knows spending has slowed down, they would work on it. But easier said than done. I mean, we're talking about in government order coming out, government spending to pick up, order execution to start, the multiplier to kick in. While the intention and ambition of government is to increase and prime the economy, do you think in reality it's not going to be at a very fast pace?
No, Nikunj, I think they really did have a problem in the first 3 months and the first 6 months on account of election and election-related uncertainties. So I do think that in order to, align with the budget target, maybe they won't be able to achieve the entire target. But even if you assume 90 to 95% of the capital spending were to be achieved, they have to show a humongous growth in the months of December, January, February, and March. So it is going to be a tough ask for them. But I do feel that from the last 6 months on a sequential basis, there is going to be a substantial increase in government spending. But having said that, it seems to me that the main two stories of this phenomenal GDP growth that we have seen in the last 2 years is one is the government spending and the capital expenditure, infrastructure spending that they are doing. And the second is the real estate revival that is truly on and still continuing. Outside of these two, I think there are some concern areas from consumption and so on and so forth. The private sector, which was expected to take up the cudgel when government slowed down, clearly, I think, has not yet taken it up. And there are worries on urban consumption as well, while rural consumption might get better going forward. So all in all, it's a different kind of a mix. But like I said, the worst seems to be over, and we do expect the pickup to happen. But the pickup cannot be so much that what is lost in the first half can be compensated in the second half.
7% clearly staying elusive. That's the word coming in. Hi, Mr. Prasanna. This is Anisha joining in the conversation. So then what's your expectation as to what RBI should do in the coming, MPC meeting just end of this week? Do you think they'll blink first, bite the bullet and call for a rate cut, or stay the course?
Yeah, good morning, Anisha. Yeah, so I think the Q2 GDP is definitely a game changer from what we think will happen from a Reserve Bank perspective. They have to, the focus has been completely on managing inflation. I think they will have to subtly start shifting to managing growth without compromising on inflation. I think that's the way they will probably, look at the priorities going forward. But unfortunately, this number alone is not going to be enough for the RBI to go the whole hog in terms of cutting rates. They have to wait for inflation to settle down, especially after so many concerns that have been spoken about the governor, where he has spoken about the need for inflation to be sustainably at 4% and the need for patience and all that. So it will be a bit of a credibility issue if the RBI changes stance wholeheartedly. But they can do one of two things, or rather two things they can do. One is that you can actually, the view on expected inflation itself can come down because of the fact that GDP is now far lower than what we earlier thought. And that can, lead to expected the inflation estimate of RBI coming down. And bear in mind that policy is normally based on expected inflation and not necessarily on current inflation. So even while current inflation is not at 4%, expected inflation can be brought down to 4% based on genuine data modeling, of course. And the second, so that's one of the most important thing that can be done. And the second thing is, of course, repo rate cut is not necessarily the only thing. So RBI has been having the CRR at higher than pre-COVID levels of 4%. They've said 4.5%. And that extra 0.5% is something that was done during the post-COVID tightening that they did. And that is something that can definitely cut down. And the other thing they can do is to talk a little bit more dovish. So I do expect them not to cut rates into the December policy. They'll probably cut CRR by 50 basis points, maybe in two installments of 25 basis points each over the next 2 or 3 fortnights. But they will also talk dovish, indicating that there could be a rate cut in the offing in February, especially if we expect food inflation to come down and headline inflation to come within the within at least 5% roundabout. They might be able to cut because the expected inflation would still be down to 4%.
The reality is that liquidity is tight. Now, Reserve Bank of India will have their own numbers to defend every time we make a tight liquidity argument. The bottom of the pyramid is not getting the due credit which they want. NBFCs are feeling choked up. And in general, when you ask a MSME or SME, it is not like a easy cakewalk for really the bottom of the pyramid or the lower end of the industry in terms of getting fresh bank loans. That is the problem. It's not about half a bips here or half a bips there. Even if rates they go down, there has to be enough and more willingness to lend.
No, so Nikaj, that's why I'm making a point. There's a clear difference between a repo rate reduction and a liquidity injection by way of a CRR cut. A repo rate reduction keeps the amount of money in the system constant, but tries to reduce the price of liquidity. There, your angle of the small and medium businesses, whether they get the benefit of a lower interest rate, you can question it. But when you start reducing CRR and infusing base money into the system, that actually leads to more money at the hands of the banking system. And there, the argument would be that they would be more inclined to lend at some point of time when the liquidity is there. Also, bear in mind that beyond liquidity tightness, beyond all these, RBI has also been, uh, wanting the banking system to slow down and bring down the credit deposit wedge. That's played out. I mean, you had the credit growth much higher than deposit growth 5-6 months ago. Now today the credit growth is far lower than deposit growth, so that has played out. So it's time for, of course, beyond a few specific factors that RBI, specific sectors that RBI would still be mindful of and keep the macroprudential concerns on. I think beyond that, the overall pull to bring down credit growth of the banking system, which was emanating from the Reserve Bank, that I think can slow down. So from all these perspectives, I think a CRR cut would be a far more important move to enable banks to start lending especially to the small and medium businesses that you're talking about.
Appreciate your time. Thank you so much for giving us your assessment as to what the state of the economy is, what we can expect down the line by way of rate action, as well as that GDP shocker as we're describing it.
If you like this video, then like, share and subscribe to ET Now.